Good evening, and welcome to episode 33, Inflation Galore. Good evening to you, Awi,
Good evening, Mark.
and good evening to our listeners. Hopefully, everyone have a great week so far. Almost the Valentine's Day. This is your host, Mark Yu,
And Wawi Santos.
and welcome to the Mark Yu and Wawi Show. A disclosure: this show is made for sharing information purposes only and not to be considered investment advice. We record once a week. I and Wawi are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. To our co-workers in the medical field, thank you all for your hard work. So on our previous episode, episode 32, entitled Earnings Boom, we dissected big tech earnings, Google, Amazon, and Facebook. We also discussed different sectors and industries and how has their performance so far this year. We also looked at some weekly sentiments, which we're also going to take a closer look at in a few minutes. So for this episode, we're going to look at the ongoing sentiments of the stock market. Believe it or not, according to the American Association of Individual Investors, which takes this survey once a week, mostly during Thursdays or Wednesdays, investors has gotten a lot less bullish from February 2nd. So the survey that ended in February 9th indicated that bullish sentiment went down from 26.5 to 24.4. Pretty much a bearish sentiment as well. So looks like most of the bullish investors and bearish investors went into the neutral camp, and bearish investor sentiment from 43.7% went down to 35.5%. Still quite more than the historical average of 30.5%. So looks like a lot more people jumping into the neutral camp and not being overly bullish or bearish at this point in time.
They're definitely weighing the situation,
Mhm.
the geopolitical situation in Ukraine,
Right.
the impending invasion of Russia of,
Mhm.
of Ukraine is also taken into consideration today.
Yep. Interesting events in geopolitical segment, as you said. While the fear and greed index is currently at 34. So a week ago it was a 35. So not much movement in the fear and greed index. If we're going to take a closer look on the historical aspect of it, we're still averaging at the lower part of the spectrum, nearing fear instead of greed. Volatility for the S&P 500 for the past week increased by 15%, meaning it's been a rocky week for the stock market for the S&P 500, for the 500 largest companies in the US. For the volatility index of the NASDAQ, which comprises the big tech companies. These are the Amazons, Googles of the world. It increased by 13.6% for the past week as well. If we're going to look at the 1 week performance, we are looking at an outperformance by basic material companies. The industry for that segment returned 3.23%, whereas energy as well. These are the only two sectors that outperform or return positive this week. Basic materials and oil or energy sector. Energy sector is up 2.23%. So my guess is both are very much in tandem with rising prices. So rising raw material prices, cotton, what else, lumber, and all of that, including oil, as the economy returns to pre-pandemic stage or recovery. So as the prices and accompanied with the inflation, as what we will discuss in a little bit. Since the start of the year, energy is the number one performer, 22.29% return, followed by financials, which is at 2.37%. So these are the reopening or place that investors were looking at to invest in, to put their money in as the economy recovers from the onslaught of the pandemic. which interestingly kind of like pulled people back to their work from home situation in January, just last month, because of the climbing cases, which now, as of last week, as we have already discussed, has cases have at least since then declined, which is a good sign for everybody.
Yeah,
um,
speaking of reopening,
mhm,
some of the big banks have dropped their mask mandate in their US offices. That includes Goldman Sachs, JP Morgan Chase, and
right.
Morgan Stanley today. Says
That's
they are dropping the requirement for staff to wear masks in the office.
oh that's a
That's a
good
good sign.
sign. Mhm. Yes, sir. So aside from energy and financial, everybody else returned negative since the start of the year. Technology is the worst performer, followed by real estate. Interestingly, they say that real estate is a good inflation hedge, but if you invested in a real estate sector, you're down almost 11% since the start of the year. Technology, nobody would be surprised if I say that's down 12.2% since the start of the year as a group. So put call ratio, this is a options market, the tail that wags the dog, as they say. We are still seeing high put call ratio, meaning that people are buying options, put options specifically, to protect themselves from any sell off that can happen, as the Fed rate hike, the long awaited one, is coming soon. uh, it's a couple weeks from now, it looks like, or at least 3 to 4 weeks, next month in March. The fear and greed index of the Bitcoin cryptocurrency, the cryptocurrency craze, I guess, currently at 50, much very much at neutral compared to last week's extreme fear of 20. So now we're going to look at some flows. So this was just published this morning. This is from Seeking Alpha, entitled Funds See Outflows for Second Week, Driven by Extensive Money Market Withdrawal. So for layman, money market is like where we put our money when we don't know where to put them. So it appears that there are a lot of people withdrawing their money from the money market, planning to invest somewhere big time. So this is data according to Refinitiv Lipper, which is I think owned by Reuters. So latest weekly fund flow, we saw an outflow or 16.6 billion. However, this figure is skewed by the large withdrawal from the money markets, which lost 33.4 billion during that period. Meanwhile, looks like stocks or equity funds attracted nearly $16 billion. So just last week, me and Maui were talking about some huge outflows coming out of North America and going into Europe and Asia. But
Mhm.
this week looks like stock market attracted some good amount of good amount of money, 16 billion. While taxable bond funds took nearly 700 million. Mm, From an equity ETF vantage point or stock ETF, looks like IVV SPY gained five, looks like 5 billion. Oh, they gained 17.4 billion in net new capital, led by BlackRock's iShare IVV and SPY. So the largest equity outflows came from the Russell 2000 IWM, which experienced 1.6 billion outflow. So people are not liking small cap stocks just yet, Huawei, despite the massive sell-off that we have witnessed since, I guess, November or December, since ARK investments decline, looks like.
Yes. I have not done any research on the inflows towards
Mhm.
mid cap and small cap this week.
Right.
But all I know is there's some interest in it. And once we know what the Fed is going to do, we should expect some more inflows into the mid cap and small cap.
Mhm. Yeah, it might be an interesting segment to look at. Russell 2000 and primarily the stocks in there, the major stocks. I think for some reason, some meme stocks also are part of the Russell because of their recent flight uh, in terms of their share prices. Well, now they've corrected big time, but once in a while, at one point of in
Mhm.
our history, there were like the captains of the ships that
Mhm.
that helped rise, that helped increase the stock market valuations to all-time highs last year. So this is a study or a research published by Bank of America. So they say stocks see large inflows. This is the kind of reflecting what Lipper have just reported that we just discussed. So according to Bank of America research, their stocks saw large inflows while bonds and cash suffer. So cash, in my opinion, is also similar to money market. So it kind of reflects what the Reuters or Lipper Refinitiv data indicated. So global equities saw 47, nearly 47 billion of inflows, while investors pulled 47.5 billion from cash. So these are big investors or acting as a group moved a lot of money from cash and put it all in stocks, according to Bank of America. They also pulled at least 10.5 billion from bonds. So notable weekly highlights: US large caps saw 34 billion. Okay, we already discussed that. So quote unquote from Bank of America analysts, aggressive Fed at the moment of overvalued asset markets is not normally recipe for big returns. Hmm. Oh well, but people are still liking the stock market. Looks like wow, they're putting their money in the stocks to get some returns in this high inflation environment. So yeah, about inflation, Wowie, can you give us a heads up regarding the inflation reading that was just reported?
Yeah, so we just got the data yesterday for total CPI
Uh-huh.
increased 0.6% month over month, with the core CPI up 0.6% month over 0.5% month over month.
Mm-hmm.
It's at its highest levels since 1982, year over year at 7.5%.
7.5. Okay.
And that's talking about your food, your electricity, your shelter,
Mm-hmm.
and um, and that's not including your food and energy. So if
Right.
you combine your food and energy cost, that inflation rate would be probably at 9 or 10%.
Right. And about this inflation that's rampant now, even some of my patients are kind of mentioning those concern out of the blue, anecdotally. One of my patients were talking about some of the products that she used to buy, and now she said that you know she kind of noticed, but not in a panicky way, just sharing some story anecdotally. So it's being felt nationwide for sure. And one good thing about what we do here in our podcast is we take a closer look at these data, not just reading headlines, news lines. We also share our opinions. So in the latter part of this program, after our roll the clip segment, we're also going to take a closer look at some of the big companies that have kind of like hinted their what do you call that? Like their 2 cents about inflation. So this is an interesting chart or graph from Reuters. So even with the inflation at the multi-decade highs not seen for nearly 40 years, 10-year yields and break-even inflation rates haven't really skyrocketed
Mhm.
as crazily as expected. So if this were the case, if they have skyrocketed along with the inflation, it would have rocked saw the bond markets and the stock markets worldwide for sure. Because one thing to consider is like investors, they like us, we have our own like risk appetite or risk tolerance. So at a certain point, if the interest rates increase like rapidly, let's just say 5, 6, 7, 8, 9, 10, 10%. So at that point, you know, in response, 10-year yields started climbing up as well. Right now, it's around 2%, which we haven't seen since 2019. So let's just say 10-year yield has skyrocketed. So some of these investors who would want to protect their money and would be fine with just, let's just say 10-year yield skyrocketed to 4%, more likely they'll pull their money from the stock market and throw some of it in the 10-year yield or bonds just to make sure that they have, security in their investments. And as a result,
Mhm.
that could further be a detriment to the overall stock market, which could send it lower. So right now, we're
Mhm.
not seeing a crazy amount of bounce in 10-year yields as
Mhm.
is in this chart. So like what we just said, energy prices, food prices, used car, airline fares, rent, all of them are increasing on a monthly basis, like 7.5% year on year. So this is a screenshot that I was able to retrieve from Bloomberg. Interestingly, if you're gonna annualize those data, you're gonna see oil prices potentially increasing 27% this year, food prices increasing 7%, used cars 40.5%. What do you think about that, Wawi? Because since November of this year, we've been seeing charts that consumers, primarily here in the US, aren't liking it in terms of the prices, and their sentiment of buying big ticket items as such had already declined and is even declining more.
Well, it looks like people are still buying price cars at high prices.
Hmm.
Um, I don't know if there's a slowdown. I think I've been seeing some slowdown on the used car market a month ago. I should expect a trend in the slowing down on car buying because of the high cost of buying a
Right.
car, used or
Mhm.
new. If you can get a new car, that would be, uh, I think, extraordinary right now with the limited supply of new cars.
Totally. And the missing chips, right? Some of the cars are being sold without the
Hmm.
semiconductor chips.
Yeah, and
And
that was
uh
evident with Tesla.
right.
They found out that Tesla had taken some chips off their steering wheel
What?
in some of their Chinese cars. Supposedly would not affect the drivability of the car, but that's put into question why they did that.
Right.
I think they just uh, so assumptions are they did it to meet production.
Hmm. Oh well. So we'll see in the near future how well that would be, because a truck, let's just say, missing a chip that's responsible for Bluetooth connection would kind of like bring you back to the analog or digital years where you can't even use your car or truck satellite to play music or whichever. But that kind of, it's up to the future how we're gonna be tackling that. But so, Market Watch came out with an article here that was just published or updated this afternoon. It says the average household is spending an extra $250 a month or $3,000 per year due to high inflation. But middle aged Americans are paying even more. So, definitely, consumers are being hit left and right. A
Mhm.
lot of price increases. $3,000 a year, that's about $1 an increase in rate pay, because at least a year, if you're going to work 40 hours a week, that's going to get you 2080 hours. So if you know earn at least $1, spend $1 every working hour, that's about $2080. But
Mhm.
regardless, so families are spending more. Consumers, probably as a result, would end up with lower savings rate at this point in time, which could indicate or probably pull back some more uh, spending power from consumers, or especially with big families. So,
Yeah, the
uh
question would be the wealth gap between the rich and the poor
right.
moving forward. If we can't uh, control that, then that would be something to consider in the next 2 years moving
Right.
forward.
And we kind of like saw that back then as well. You know, the Occupy Wall Street, right, Wowie? Back then when the
Hmm.
great financial crisis, you know.
Yeah, we're seeing the same thing. It's affecting market sentiment and consumer sentiment
Right.
in the United States, and now we're seeing protests both in the Canadian and United States side
Mhm.
with the truckers
Mhm.
blocking movement of goods on the two main roadways going in and out of Canada.
Right, but I think that's more of them being required to have vaccines by by Canadian Border Patrol, I think, and they just decided not to do it, not to pass
Mhm.
through and just make a protest out of it. So, as a result, yeah, that would indirectly affect or possibly directly affect inflation prices as well. So, as a result, big banks in Wall Street. Apologies for the poor quality of the screenshot. No, I took it while I guess my phone is buffering. So these are Wall Street banks: Deutsche, Citibank, Nomura, that's a Japanese bank, HSBC. All now see at least 50 basis point hike this March. So this hasn't occurred for quite a while since I think Paul Volcker during the great inflation crisis back in 80s, I think, or 70s.
Mhm. And
So,
some Fed member, I think a Fed member had mentioned he's all for a full point increase.
oh yeah, I think that was Bullard, right?
That's Bullard today. Yeah, he
Yeah,
mentioned that.
a full point increase. So, Federal Reserve, its chairman's, seeing already signaling that we're gonna see a lot of price Fed rate hike just to
Definitely
tame.
hawkish.
Definitely hawkish. That's true. And hawkish is not so much appreciated by the stock market overall. If you have a hawkish Fed, that means that they're not into giving out mm, like free money. I would say that would result into some stock market pullbacks, as most of us are already anticipating. So interestingly, if that's the case, now we as regular investors, right? While we kind of already see this coming. So what if Federal Reserve did zero point 0.5 uh, rate hike? It won't automatically, resolve the inflation for sure. Like these companies would still probably be charging the same prices. I rarely have seen Costco did a lot of price. Well, they do some discounts every now and then, but broadly, I don't see it like happening right away. So for example, Fed increases zero point 0.5 basis point on March. Like the following day, companies would start saying to their employees, "Oh, okay, we'll take your hourly wage your hourly wage lower than $1 now." Because so it's not like ultimately immediate impact. But what I'm
Well,
trying, go
yeah,
ahead.
well, let's hope so. Let's hope so. It all depends on how people will react to to the rate increase that we
Right,
see coming. How the companies and corporations will respond to that rate increase for pricing advantage.
right.
Um,
That would be
I,
interesting to see for sure. Hmm.
yeah, but I think the bigger force behind it is the delay in the supply chain
Hmm.
that we've been having for quite some time now.
Right,
And I don't think we're getting any headway with regards to some of the trade um, discussions with China regarding certain tariffs, regarding certain goods moving into America.
mhm,
But we're already seeing the demand here in this country for goods outside the country, as we're seeing trade deficits increasing. So we have not met the demand yet.
there's still
And
demand. Yeah.
There's a huge demand that is not reflective of the trade deficit. The trade deficit is actually not reflecting the true demand that this country needs.
Right.
70% of the US GDP is in consumption, so
Mm-hmm.
we are really dependent on how well we satisfy our consumers.
Right. Which we're gonna see in a little bit in terms of their sentiments for sure. Yeah. Jumping on forward to a couple of observations that we notice in some of the work from home companies. So we'll start with Zillow. So Zillow is technically not work from home, but they kind of like experience a heavy demand on their website as people started looking, researching, making deals, um, trying to move from a concentrated area to far more less dense area like suburban areas to, adopt to a new lifestyle as the pandemic rolls on starting in 2020. So interestingly, Zillow kind of like faltered with their iBuying program, which cost them a lot of money. And now they're seeing a lot of like workforce cut or at least, reduction for this company, which is probably a tech company, which we typically would imagine as a high flying company. This company that's involved in real estate in particular will cut its workforce by 1/4 or 25%. So, just by looking at this article by MarketWatch, this came after a year where they hired 45% more of their employees. So, this is quite interesting. So, from 8,000 employees as of December 31st up to 2,500, they're going to be reducing it by quite a good amount, almost 2,000 to 6, ending up with 6,000 employees. So, one thing to watch out for because we're looking at job growth to satisfy the Fed's criteria in raising the Fed rate hike. But the thing is, like, we're seeing some sort of like contrary behavior in some of these companies. The next company that we kind of notice is the Peloton. So Peloton primarily is like the work from home. Uh, it's like a perfect example for work from home stock or company. So people don't go to, let's just say, gym, Planet Fitness or Gold Gym. They buy themselves a quite of a unique tech gadget that will make you run 24/7 hopefully. That way you kind of like justify the pricey treadmill that this company is selling. So this company Peloton came out with a warning that they might actually slow down and cut some production in their treadmills as early as a couple weeks ago, I believe, which sent their stock tumbling down. And
Mhm.
now they'll be firing a lot of their employees as well as a result. So the fitness company, according to this Wall Street Journal article, cut 2,800 jobs just this Tuesday. So as a result, the employees made their resume and LinkedIn information and email readily available here in in a spreadsheet in Google Docs. So I don't know how this works, but at least some of them are being contacted already from some prospects. So as you can see, their work mode preferences, they put remote, hybrid, on-site. So quite interesting nowadays that people are freely, you know, willingly providing their information online, just like this. So we jump on to the consumer sentiment, which was briefly discussed by Huawei. This is comprising the US economy. This is the backbone of the US economy. Any weakness on this could cause lesser spending in the near future, would cause economic slowdown. Hopefully, it would not cause a market crash, but you know what we're trying to say. So, this is a report that just came out this morning, fresh from the oven, entitled US Consumer Sentiment Weakened Sharply in Early February, University of Michigan. So this level hasn't been seen since October 2011. This is quite troublesome. The Michigan sentiment came in February at 61.7 compared to 67.2 in January, and that 61.7 this month missed the consensus or Wall Street estimates of 67. So Wall Street estimate is already experiencing a slowdown, but not this big. So this is a troubling sign. So me and Huawei, we've been harping on this since October of last year. Despite that, Wall Street or stock market has still kept on chugging along and hitting all-time highs. Not until the Fed started wavering their transitory image of inflation, which they thought of like, you know, already hinted that they might start increasing rate hikes and stop their bond buying program by March altogether. So we're going to see that in the coming weeks for sure. But yeah, this is quite troublesome. Consumer sentiment is now at its lowest since 2011. Uh, well, it says here there is some potential for rising confidence. So now we're predicting a confidence bounce back as the Omicron wave ebbs, but any marked improvement is unlikely until inflation pressures ease, according to economists. So consumer sentiment not looking good, Huawei.
I'm still saying it's dependent on the supply.
Mm-hmm.
It's reflected on the building home price too, right? Home prices are going up,
Mm-hmm.
and but people still need homes.
Right, the demand is
Even
still there. Mm-hmm.
the demand is still there, but they can't afford it.
Yep. Um, well, what's gonna happen here is like some frustration would probably ensue from all this. But yeah, this is the website of the University of Michigan. So from last year, we experienced a 20%, nearly 20% drop in terms of consumer sentiment, and current economic conditions have dropped 20.5%. So not a whole lot of people are feeling the good vibes coming from this inflation mania. Index consumer expectations nearly down 19%.
Mhm.
So it says here on this website by the University of Michigan, the impact of higher inflation on personal finances was spontaneously cited by nearly one third of all consumers, with nearly half of all consumers expecting declines in their inflation adjusted incomes during the year ahead. In addition, fewer households cited rising net household wealth since the pandemic low in May 2020, largely due to the falling likelihood of stock prices increases in 2022. So this is kind of like reflecting consumer sentiments along with the stock market performance. So
Mhm.
near fewer households cited rising net household wealth. Okay. So a lot less people are getting bearish on the stock market primarily.
Yep.
So not so long ago, this is an old article from Business Insider. As of November, we were already seeing consumer sentiment hitting decade lows, even as stocks, housing prices, broader economy are at record highs. So consumer sentiments already were declining as of like October and November, as we have already discussed. So this is slowly encroaching into the overall economy. So in addition to this, as we already have highlighted that consumers are getting hit left and right, mortgage rates, this was published just this morning by MarketWatch, mortgage rates jumped to the highest level since the emergence of the pandemic. Americans are pessimistic now about purchasing a home. A record
Mhm.
low percentage of Americans believe now is a good time to buy a home due to eroding affordability. So, house prices have stayed up. In addition to that, interest rates have now climbed the highest in more than 2 years. So,
Mhm.
altogether, this is not a good sign for a family that might be tight on the budget. But for those who are willing to jump, you know, jump I would say jump the bridge. No, jump
Yeah.
the rope. I would say jump the rope. They would probably have no choice but to pay up for the elevated housing prices, as well as swallow the increase in interest rates at the same time.
I think the bigger pressure there is the home price being elevated.
Hmm.
The 30-year mortgage is still pegged at 3.83.
Yep.
So it's still okay, but the home prices are way above what we consider norm.
Right. And according to the Doug Duncan, chief economist for Fannie Mae, he said in a report that younger consumers, more so than other groups, expect home prices to rise even further. And they also reported a greater sense of macroeconomic pessimism. So,
Yeah, so something has to give. So I think um, this is not gonna be like the 2008, 2009, um, you know, home lending
mm,
crash, but
definitely not. Yeah.
not that, but definitely home prices should give one way or the other.
Yes.
So there's a lot of prediction that it's gonna go up about 7% this year,
Yep.
but there might be a strong enough pressure for it to go down if there's not enough buyers in the market.
Well, I think there's still going to be plenty full of demand, but there's going to be a little bit of slowdown, as already been shown here by consumers, as the younger consumers, as the economist has said. So probably a little bit of slowdown in demand, but because I believe like now we have a bunch of like guards, like a bank would no longer just qualify you for a mortgage loan just by without you showing enough paperwork, right? Like
Oh
enough
yeah.
income to support the mortgage payments. So I'm pretty sure that the housing prices won't crash. Nothing crazy like what just happened more than a decade ago, but the demand would still be there, although there will be a little bit of slowdown. As you've said, 7% rise might still be, within reach for this year despite the slowdown. So here's an interesting article that supports our kind of like opinion on the home buyer demand. So this is from CNBC that was published a couple of days ago. Home buyer demand for mortgage drops 10% as higher interest rates price some people out. So as you've said, it's now 3.83 at 30-year mortgage. However, mortgage applications has dropped 10% compared to previous week and now is down 12% since last year.
Mhm.
Refinancing as well have seen a slowdown, fell 7%, 52% lower than last year. So definitely some decline ongoing. Now we're actually seeing it. Some data being supported, our opinion being supported. So like what we've seen since October last year, consumer sentiment has been going down for houses. It was only so November, December, January, February, 4 months after we'd noticed early signs of consumer sentiment disliking big ticket items.
A lot of these names
Oops,
began to correct it. We're lapping on a full.
sorry about that. Some technical errors. We're about to jump onto our roll the clip segment.
Tom
So
Lee.
yes, sir. So this is the only roll the clip segment we got for this week, since we're on a time crunch. So this is a interview provided by CNBC of Tom Lee, none other than Mr. Tom Lee of Fundstrat. So this is entitled Tom Lee. Now's the time to pick winners and losers. This is viewed by almost 85,000, well, 85,569 views in YouTube. So let's roll the clip.
So a lot of these names began to correct it. We're lapping on a full year of some of this corrected price action. I wonder how much you think has been built in and is starting to look constructive in retrospect.
Carl, this is probably the time that you'd start to try to pick winners from losers because, as you know, as a cohort, a lot of these stocks in 2021 had super normal demand and they became very popular. So you had a combination of both much better earnings plus huge multiple expansion. And now a lot of these are broken charts. So if an investor does their homework, I do think you're going to find some real gems that can compound at earnings growth. And if you don't have much multiple compression, these are going to be great long-term winners.
What examples?
I mean, for instance, I would say companies like Shopify, for instance, which have really been structurally really changed the economy, right? Because they've made it easier for merchants to do business. I mean, these are companies that are going to have permanent benefit in the future, but they've had to correct. So I mean, that's a name that comes to mind. And I mean, I don't know the valuation of companies like Zoom, so I don't really look at these names that carefully. But it's part of the everyday lexicon, so it is something that has traction beyond the pandemic. So I think investors have to do their own homework because it is sort of like sifting through rubble.
Yeah, and I mean, Peloton and its massive re-rating showed us that companies that pitched themselves as tech companies during the pandemic, they may have gotten that valuation at one point or another, but haven't lived up to it. And I wonder, do you think that there are any other sort of industries that could see that re-rating as well? Something that comes to mind maybe is ride sharing, but it hasn't run up at all really during the pandemic. But do you think that it's having more trouble showing that it has a real tech component?
I mean, ride sharing is a good example, like the Lyfts and Ubers. I think it's really probably a question for investors about how they allocate capital and their margin structure. But, is the demand for the services strong? Yeah, it's clear. And they've actually, they've had an impact on how people basically move around and get food delivered and how they think about their lives. And it has also created essentially a gig economy. But again, it's really, for me in 2022, in a year where it's transitioning, it's probably easier for investors to find structural growth, and then where multiples are reasonable. That's really where you're going to see some potential for expansion. And like for instance, I think even the FANG complex itself looks pretty reasonable.
The FANG complex itself looks pretty reasonable. Like I think they primarily, I would say Facebook. What is Facebook's current price to earnings? I don't know. It's let's see, 15 times, 15.9 times. So Facebook is pretty cheap right now. I'm not saying to buy it. Disclosure: I have some Facebook shares, but against the market of 21 times, which we looked into last week, it's pretty cheap. Google, on the other hand, is still quite pricey at 24 times. Let's see Amazon. We're just comparing this one after the other. Amazon at $3,000 a share. Whew, 47 times. Oh, how about Netflix? Netflix have fallen crazy. Well, this is 36 times still. Wow. Well, believe it or not, Bill Ackman kind of like timed the bottom on this stock for sure. He bought on Friday, right? I think right here he started buying 384. So now he's up about, well, not so much, 1.8%. But regardless, FANG stocks, as Tom Lee has mentioned, sounds pretty much reasonable at this point. So, but going back to inflation, so we're almost done for today's podcast. If you guys are still here, we appreciate you. Please hit the like and subscribe and share buttons if you appreciate us. Any feedback is appreciated. You can send it over at markuwawishow@gmail.com. So regarding the inflation, this is from the New York Times. There are recent comments from company executives on earnings calls that suggest that prices may not come down anytime soon. So this is from CEO of Hershey's, Michelle Buck, quote unquote, "As we go into this year, we want to carefully keep our eye on the potential impact of a broad inflation on the consumer." According to CFO of PepsiCo, Hugh Johnston, which we're going to take a closer look into their earnings call in a little bit, quote unquote, "It's going to be a pretty healthy pricing year to accommodate the cost increases." Pretty healthy pricing year, he says.
I would agree with that.
Mm-hmm.
With the rate hikes, we should see some good pricing.
And according to Kellogg's CFO Amit Banati, quote unquote, "We are expecting double-digit inflation double-digit inflation in 2022, and the bulk of it is market-driven. So more demand for Kellogg's cereals for sure. That's what they're forecasting. So if we're gonna look into Tyson, no, this is Tyson.
Mhm.
Huge Johnston. This is it. So looking at PepsiCo's recent report, they were asked on how they're gonna deal with, or in terms of the rising inflation. So Hughes Johnson said, obviously as our hedges roll off and we move into a new round of commodities, we are going to price in a way that allows us, at least for the full year, to try to keep our margins pretty well intact, which means that 7 pricing will probably be around there. 7 pricing. Maybe that's several, which means that the several pricing will probably be around there. Maybe even a little bit stronger for the year. We'll see how it plays out and react to what happens with the facts in the marketplace. But it's going to be a pretty healthy pricing year to accommodate the cost increases. So that's, partially what we've quoted about him earlier. So Pepsi company owns Frito-Lay, for those who are not aware, aside from the Pepsi-Cola company, also as well as Tropicana, I believe. So the Pepsi company is a big company. It sells a lot of snacks and sodas to the consumer. So as a consumer, I also have some Ruffles and Doritos in my snack bar. So for sure, people will feel the impact in terms of like rising prices if inflation doesn't subside. So one company that I would also take a closer look at is Tyson. So Tyson is one of the largest meat packers and meat producers here in the USA. So if you could see their report as of recent quarter, the volume that they have produced as a total just rose 0.3%. Specifically for chicken, they produce 3.6% year over year. For pork, barely 0.5% at 0.2%. Beef, it increased 6.2%. So why am I targeting these numbers? It's primarily because despite the less increase in production, the company saw huge increases in their report. They beat Wall Street estimates in their earnings.
Mhm.
And the reason why, it's not because of production, it's because of their pricing power. So they were upfront about this. They said in their PowerPoint presentation that was just released a week ago, I believe, earnings increased primarily due to pricing to offset inflation. So if you're going to look at this graph, it says sales price mix, they generated $2.1 billion. This reflects their ability to improve their prices because of the substantially due to strength in beef and pricing to achieve a fair value for their products. So this is one thing to look at for sure, because some of these companies are able to maintain and even grow their margins, beat Wall Street estimates, despite the rising inflation due to their pricing power.
And
So
Tyson is keeping their dividends the same.
they are. Oh,
Mhm.
they're not sharing the blessings, I guess.
Oh,
They're-
yeah, they're sharing their blessing. They have not cut down on their dividend.
oh, okay.
It's
That's
still
pretty
the
cool.
same
Okay.
at 0.46 a share.
All right. Well, I think somewhere at some point they kind of like hinted that they're gonna increase their dividends, right? Or no?
I've not read that, but their total annual dividend is like $1.89 per share.
Oh, pretty good. I would say $1.89 a share. And how much is the
Or
stock price? 98%? $1.89
$98 per share.
would give you 1.9%. Eek. You'll still gotta be at least negative 5%, count in the 7.5 inflation rate that we're currently experiencing if we're gonna put all our money in Tyson. But yeah, According to the same company, Tyson, all segments experience strong demand, challenging labor conditions, and inflation in operating costs, especially in labor, freight, and certain materials. And we expect these trends to continue through the remainder of fiscal 2022. So looks like we're in for an inflationary environment for sure. So another company, the last company that we're gonna take a look at is Costco, the warehouse company that sells a lot of products in their you know in their outlets. So
Mhm.
Costco have never failed their investors.
Mhm.
Costco, as of its recent report, delivers another shock and awe sales report, according to Seeking Alpha. They handily beat again Wall Street expectations.
Mhm.
So if we're gonna look at their recent discussion of inflation, they were asked like how they would be able to balance it out. Looks like, according to Richard Galanti, which is the CFO, let's see here, pricing power wise. So, well, he said here, because of our relative purchasing power and their relationships with their vendors, with their suppliers, they were able to mitigate those increases in any way, shape, or form they can. Ultimately, um, looks like Costco is taking a little more less markup, and maybe then taking a less markup. So Costco is actually trying to prevent any significant increase in prices or sales price in their products. But overall, quote unquote, I think we've done a relatively good job of that. And there is inflation in those numbers. Those numbers are kind of a combination of our cost increases as well as our some price increases. And again, it fluctuate there. So hopefully, he says, we're getting towards the top and that it'll start flattening out and subsiding, referring to inflation. So Costco, meanwhile, sees some promise, sees an end, like a window near, like, at least an opening for a peak inflation coming soon. So different people, different companies, different major companies expecting different results. Tyson primarily, this is like a food supplier to everybody. So on the other hand, so they're not seeing any inflation price reduction coming soon. Whereas Costco, as a wholesale retailer, hopes for a near peak inflation. So different contrasting elements there. At this point in time, let me just play this. Well, Wowie, I guess that does it for now. Do you have any quote for the week for our listeners?
Yeah, from Bill Bernanke,
Uh-huh.
the Fed chair during the 2008-2009 crisis. So he said, the Federal Reserve cannot solve all the economy's problems on
Uh-huh.
its own.
So cannot solve all the economy's problems, but what was that?
The Federal Reserve cannot solve all the economy's problems on its own.
Oh, on its own. Right. That kind of makes sense. That brings into mind like the stock market is not the economy, right? So the stock market will do what it's bound to do. The economy is going to do what it's bound to do, but overall it'll be each and every one of us that would be able to determine where the economy would end up being. Well, at this point in time, everything is up in the air. At least some banks predict a lot of rate hikes. Well, all of them, majority. So we're gonna see the impacts of that in this overall stock market. Hopefully, we're all ready for whatever it entails. Well, Wawi, thank you so much for coming on this evening. I appreciate you joining me. And
Yeah,
thank you
thank you
guys
so
for
much.
sticking with us. You're welcome. Listeners, that does it for this episode of Marky and Wawi Show. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark Yu signing out.
Wally Santos signing out.